Hey everyone, welcome back to the Kuderna podcast. I'm Bryan Kuderna. This is the show in which we discuss all things wealth. And as you know, I like to define wealth in its original meaning, a state of well-being. That's why we cover everything from money and personal finance to economics, to having some of your favorite athletes on here to talk about health and high performance, restaurateurs, entrepreneurs, authors, and so much more. But today we're going to be coming right on back to my bread and butter, if you will. And we're going to discuss investing in an election year. So I know right now as I'm recording this, it's May of 2024, which means we've got about another, 5-6 months until things go absolutely nuts with our next presidential election. And as I'm sure we're all aware, as it stands right now, we are looking at the two candidates being President or former President Donald Trump and current President Joe Biden. They are the two oldest presidential candidates in history, and they're actually set to break their own record that they set 4 years ago. So it's definitely interesting times, polarizing times, a lot to talk about, a lot to go over, but the show must go on and the stock market must go on. So I think, over the past couple years, anyone who's really been paying mind to their portfolio or what's going on in the economy, they've gotten very well acquainted with inflation. Okay, we understand the impact that's had not just on our wallets, but on the overall economy, and also the Fed and Fed Chairman Jerome Powell. Prior to this rise in inflation over the past couple of years, a lot of people out there probably couldn't even tell you who the Fed Chairman was and may not even have heard him speak before. But now all of a sudden, with inflation being public enemy number one, something that we're still contending with here in 2024, those FOMC meetings when the Fed gets together and they decide what they're going to do with interest rates, that has become headline news. And you can see the impact that has on your investments just by rumors of what the Fed is thinking about doing. So we'll talk a little bit about that today too. Does the president really have much, carry much weight in what happens to the investments in the stock market? Or is it more governed by the Fed? And that old saying, you can't fight the Fed, if that's really what rings true. So what we're going to dive into today is talking about historically what's going on when we're at these times, when we're debating elections, what goes on with the stock market. And, in Republicans, Democrats, the good, the bad, the ugly, what it bodes for your money. So hang on tight. But before we get into it, again, I got to remind everybody, please do subscribe. Please like this channel wherever it is that you're listening, or if you're watching us on YouTube. That really helps us, continue to attract really cool guests and get to just offer you guys more good content. So don't forget to subscribe. Don't forget to like it. And if you like today's episode, a little shameless plug, I got to ask everyone to go check out my new book. I think you could see it right there on my shelf. What should I do with my money? Again, that's Economic Insights to Build Wealth Amid Chaos. We talk a lot about these exact topics. How do politics, how do economics, how does the Fed, interest rates, inflation, labor, how do all these things kind of melt together and affect your money and your investments? So if you want an even deeper dive, definitely go check out my book. You can listen to the audio, you can download the Kindle, or you can go get that paperback. And, let me know what you think of it. I always appreciate the feedback as well. But without further ado, let's get into today's discussion on investing in an election year. Okay.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
Okay, so just to bring everybody up to speed as we sit here in May of 2024, so far, all in all, it's been a pretty good year. And it's funny because whenever you go into these years, there's so much speculation out there. You can find pundits that will tell you it's going to be a great year. You can find just as many saying, hang on tight, we're predicting a crash. There's so much out there that you can listen to if you want to feel good or you want to feel sad. You can find a speaker or a commentator that will certainly get you there. But let's look at just the raw data. And in the first quarter of 2024, it was a really good one. All right. It was better than I think most would have expected. And it was really led again by the AI stocks, or artificial intelligence. In addition, bank stocks performed well. Dividend stocks also pushed equities higher. But if we focus on AI, what are often referred to as the AI 5, which would be NVIDIA, Microsoft, AMD, Taiwan Semi, and Broadcom. If we take those 5 stocks and put them together, they averaged a positive 33.5% return just in the first quarter. Okay, so that really led the way. Just like I said, we were getting tired of hearing about inflation a couple years ago and still tired of it. I think AI is what you're just going to be hearing about nonstop, and for good reason. It's here to stay. It's having a monster impact on every facet of life. And also what was kind of interesting in that first quarter is usually people expect certain things to be hedges, and when one goes up, the other goes down, and try and tie correlation to different sectors of the economy. So the S&P 500 had eclipsed an all-time high in the first quarter and added 10.2% in the first 3 months of the year. That was great for investors, classic investors. But also, this was, a rare time for gold. A lot of people see gold as a safe haven. That's where you go when the market's going haywire. Gold eclipsed an all-time high in the first quarter of this year. And in spite of all that, then we start to look at cash. Cash is king, money market savings. That's where people want to hoard cash when times are bad or we don't want to be in the market. Well, money market assets remained near an all-time high of $6 trillion in the first quarter of this year. So in spite of the S&P having an awesome first quarter, in spite of gold, that safe haven or hedge, also doing really well, we're seeing record amounts of money sitting on the sidelines in cash. And a part of that certainly is with higher interest rates now. You can find these high yield savings accounts out there flirting with 5% interest. So for the conservative investors or people that say, hey, I just want to stay liquid, cash is king right now, no pun intended. So interesting first quarter, but again, that's the past. I'm recording this in May of 2024, and April was a terrible month. Okay, that's a lot of the AI stocks I was referencing, the S&P 500, a lot of correction, if you will, there, where some of those holdings and investments started to give back some of the gains we saw earlier in the year. Okay. And again, a lot of that having to do with what the Fed has been talking about with interest rates. So I know this episode's all about investing in an election year, but there's other things that go on inside of an election year. All right. Inflation has been sticky. And we've heard Fed Chairman Jerome Powell say that, he's still continuing the battle against inflation, and that the interest rate cuts a lot of people had baked into their investments to happen this year, maybe in the summer, or if not earlier, they've hinted at those rate cuts may come later in the future, later than initially anticipated, until they can be confident that inflation is under control. So that's kind of where we're at right now. So you have some different dynamics going on that are, in some instances bolstering the stock market, and then in others we see it, pulling back in. Okay. So that's just a quick snapshot of where we are today. But of course, I want to get into a little bit of not the political side, but just the history of what it's like to invest when we are in an election year. And this is a very unique one in which we have one candidate, Joe Biden, our president, is 81 years old. And then we have our other candidate, former President Donald Trump, who's 77 years old. And that's not just what I'm saying is unique. What is unique is we actually can look at how the markets performed under both of these presidents. Okay, as we have a former and a current president going head to head here. So there's a lot of history that we can analyze. All right. And we saw that Biden recently has started to leave a little bit of his far left base. He's cracking down on China and tripling the tariffs on Chinese steel. That happened recently. He's giving ironclad support, in his words, ironclad, to Israel and what's going on over with Palestine. He's getting tougher on at least the rhetoric of our border security on the southern border. So you're seeing a lot of things that as we kind of near the finish line of his first term in office and near the election, a lot of the conversation and the narratives are starting to shift. Some of them can have economic consequence and others not as much. But it'll be interesting to see what happens there. One of the ones I think that does have economic consequence, especially for young professionals, is Biden has relaunched, his war against the student loan epidemic. And what was shut down last year, his debt relief program, shut down by the Supreme Court, he's bringing that back up and trying to give it another try. And you say, well, what does that have to do with the stock market? Always remember, the stock market is a measure of liquidity. How much money is flowing through the economy? How much is at our disposal that then as consumers and society we can put to work, that we can spend in the economy and we can invest in these different companies and raise the stock market when there's more froth, when there's more liquidity there. As the Fed has taken a restrictive policy in raising interest rates, so kind of sapping the liquidity out of the market, they've eased up on their quantitative easing, their balance sheet. Again, another method for them to get more money in the economy. They're doing all things that are restrictive right now. So that's a blunt approach. This isn't a surgical attack on inflation. It's like trying to hit inflation with a sledgehammer. And that's what's, initially a couple of years ago did a lot of damage to the stock market. And now we're kind of wavering through the outcome there as the dust settles. Okay, so the point being with all of that, that's the Fed impact on liquidity in the economy. But then when we talk about, well, what can the president do? If the president can, pass a bill to forgive a tremendous amount, hundreds of billions of dollars of student loan debt, again, that's newfound money. Okay, that's not directly giving money like a stimulus package to consumers or to the American people, but it's forgiving a liability that in essence then frees up more money to go into the economy. So there's we won't get into all the student loan stuff. I'm going to do another episode again on that with some updates. But these are different methods in which the president can control some fiscal policy to maybe help the stock market. And remember, that's a key thing. No president wants to enter an election during a market crash. That is terrible news. A president cannot win. I shouldn't say cannot win, but usually does not win during a recession. So you can bet that the sitting president is going to do all that they can to kind of paint a rosier picture, at least through November. And that's what a lot of investors hope for. So we'll see over the next 6 months, how much can the candidate's rhetoric really affect the stock market. There's not a lot that Biden can do right now in such a short period of time to kind of bolster the markets, unlike maybe what I just said with the student loan relief. But a lot of that is kind of speculation at this point. So let's talk about history. Let's take a look at what the data tells us. And remember, I got to say this as an advisor, and all investors have to understand that past performance is not a guarantee of future results. We always got to underscore that. That's very important to recognize, not just for compliance purposes, but it's true. Just because something happened once doesn't mean that it will happen again. But, if history doesn't exactly repeat itself, it often rhymes. And if we look at some of the data, I think that can give us a glimpse of what one might expect. So since the S&P 500 was created, and remember, the S&P 500 is one of the most quoted indexes out there, especially for the American stock market. These are your blue chip stocks, your monster companies that really give a gauge of how the economy is performing. All right, since the S&P 500 index was created, there have been 24 elections. And 20 of those election years have provided a positive return. So that's exciting. It's only 4 times in history have we seen the S&P 500 fall during an election year. Okay, that's huge. Now, in 2020, when Biden won, if we look at some of the more recent history, right, 2020, Joe Biden wins the White House, and the S&P 500 returned 18.4%. All right, when Donald Trump won the White House in 2016, the S&P 500 returned 12%. Right? The most recent negative election year, and remember, there were only four times that had happened, but the most recent negative election year was in 2008 when President Barack Obama was elected to office. And if we remember 2008, not just for Obama, but we remember the Great Recession, all right, that happened in 2008 and lingered into, the first quarter of 2009. That was a monster hit to the stock market just when Obama was walking into office. All right, that was the worst election year in stock market history, at least in regards to the S&P 500, in which it fell 37% in 2008. Now, the best election year for the S&P 500 was in 1928, Herbert Hoover. The S&P 500 climbed 43.6% in 1928. Now, some of you might be saying, hey, that must have been a great time to be alive and be an investor in the stock market. Well, guess what happened the following year? It wasn't the Great Recession, it was the actual Great Depression. Okay, so it's not a perfect predictor of what's going to happen over a president's entire term. But again, that's usually what happens in an election year. Quick takeaway, 20 out of 24 times we've seen positive returns. Now, if we get a little bit deeper and a little more granular into that performance, history shows us that in years in which a Republican was elected, the stock market performs better. Okay. The average election year return when a Republican wins the White House has been 15.3% versus 9% when a Democrat gets elected. Okay. So now another key thing to note is I know there's a lot of conversation around this exact topic that we're discussing today on stock markets and election years. Keep in mind, the election is November 5th. All right. Meaning that newly elected, who we know is actually going to be our next president, there's really only about a month and a half left of that calendar year that can really affect some of these outcomes and these returns that I've been describing. Okay. Now, if we put Republican and Democrat aside, remember there's different things that could boost stock market performance for both parties' narratives. Republicans, usually you're talking about tax cuts, you're talking about pro-business, less regulation, different things like that enterprise and business appreciate. And that's usually where the stock market, being a leading economic indicator, we'll see, okay, a Republican got elected. We're seeing some things there that can help the economy in that respect. And then, maybe give a lift to the stock market. On the Democrat side, usually some of the conversation there are higher taxes, more regulation, things that people would consider anti-business. But on the same token, you're also talking about usually a bigger government, more possible stimulus, more possible subsidy. So there's other ways that sometimes they're getting money back into the economy that are just different than what the Republican administration typically offers. So just a little footnote there. Now, if we put politics aside, right, remove the Democrat and the Republican from the conversation, since 1952, the S&P 500 has averaged a gain of 7% during presidential election years. Okay, that's an average, because remember, they weren't all up. We did have those four that were down, and one even very down, like in 2008. So while that's not bad, 7% return, nothing to cry about, it's actually far from the 16.8% average that the index has returned in each year prior to an election year. Okay. In 2023, very well may have reinforced that. As you can recall, last year, the S&P rallied almost 24%. And I mean, if we could do that again in 2024, we'd all be pretty darn happy. But that is unlikely, I think a lot of people would say. So investors can take some comfort that, presidents seeking re-election are going to do all that they can. They're going to speak in an optimistic tone to pump the stock market. All right. They want to pump it up, whether it's through the fiscal stimulus, pro-growth regulation, just a friendlier speech to the business community. That's where, we can maybe see some more lift in the rest of 2024. Now, the Fed, remember, I started at the beginning. Some people say, does the White House, do they even really have that much weight that they throw around in the stock market? Or is the Fed the real conductor? The Fed has been very active, historically speaking, in election years. Okay, they have either hiked or cut rates in every election year since 1980, which is pretty wild to think about that. So aside from I'm sorry about that. Aside from 2012, that was the one time since 1980 that they have been inactive. No rate hikes, no rate cuts. Okay, so this could play to Biden's benefit in that we came into 2024 expecting rate cuts. The Fed has said they may not come as quickly as we initially anticipated, but they're still on the agenda. And the Fed has clearly communicated they don't see rate hikes, which is a good thing for the stock market. So that could certainly play to Biden's favor if we see a rate cut or two prior to November. Then maybe we get that bump, that jolt in the stock market, and then any good politician can try and claim credit for it. So it's important to remember that, a rallying stock market, it's not a guarantee that sitting president can win the election, but a crashing stock market is a tall order for a sitting president to win re-election during a crashing market. So hopefully we won't have to worry about that either. All right, so here's some food for thought for you guys as we have another 5-6 months of hysteria before we get to pick our next president. Keep your eyes on the stock market, keep your finger on the pulse. If you have any questions, please, reach out through social media. We're always happy to talk about new topics, have new guests here on the show. And again, keep tuning in, keep subscribing, keep liking, keep sharing, keep doing all those things. I appreciate it. I'm your host, Bryan Kuderna. This is the Kuderna Podcast, and we will see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey, 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.